Welcome back, everybody. Today we're going to be taking a deep dive
Ugh.
into the world of post-trade in financial
Mm.
markets. It may sound a little dry, but trust me, you'll be surprised by what you discover.
Oh, yeah, definitely.
I actually got a whole stack of research papers, regulations, even some news articles,
Ah,
all about central counterparties, trade repositories, settlement systems.
okay.
It's a lot to unpack. Luckily, I'm joined by our expert who's
Yeah,
going to help us navigate this complex landscape
that sounds great.
and understand why this matters to you.
Looking forward to it.
So did you know that even seemingly simple stock trades
Oh, okay.
can actually have hidden complexities and risks,
Right.
and that a single bank in the U.S. actually plays a crucial role
Oh, wow.
in ensuring global currency exchanges go smoothly?
Okay.
We'll also be exploring a recent debate on shortening the settlement time for trades from T+2 to T+1
Uh,
and its potential impact.
right.
But let's start with the basics. Could you give us a clear overview of what exactly the post-trade life cycle looks like?
Yeah, so the post-trade life cycle
Yeah.
starts right after you hit that buy or sell button.
Okay.
And, it's kind of a sequence of steps
Okay.
that ensures that the trade is confirmed, settled,
Right.
and the cash and securities are actually properly transferred.
Yeah.
It happens for both securities like stocks and bonds
Okay.
and derivatives, which are contracts
Gotcha.
whose value is based on an underlying asset.
So what are the key differences between securities and derivatives when it comes to this post-trade process?
So securities are pretty straightforward.
Uh-huh.
You buy a share of a company.
Yeah.
Once the trade settles, that share is yours.
Right.
Easy.
Simple.
But derivatives are a little more complex.
Okay.
They involve these ongoing obligations
Yeah.
throughout the contract's life.
So it's more than just that initial buy or sell.
Right.
Okay.
There are ongoing payments and obligations to manage.
That makes sense.
So yeah,
Yeah.
it can be a little more complicated.
So where did these trades actually take place?
So you've got two main venues for trading.
Right.
You have on-exchange trading,
Okay.
which takes place in regulated marketplaces like the New York Stock Exchange.
Yeah.
And then you have OTC trading,
Okay.
which is more like private negotiations between two parties.
So on-exchange is more transparent then,
Yes,
and OTC is more of a bespoke agreement.
exact.
Does that difference actually impact the post-trade process at all?
Yeah, it does.
How so?
So on exchanges, trade details are automatically recorded because it's,
Yeah.
a regulated environment.
Right.
But with OTC trades, you have to confirm all the details with your counterparty.
Gotcha.
So that adds another layer.
Right, and
Yes.
risk, yeah.
Yeah.
Now, speaking of risk,
Right.
one term that kind of jumped out at me from the research was
Oh, okay.
substitution risk.
Substitution
This
risk.
sounds pretty ominous.
It is a bit, yeah.
What is it exactly?
It's essentially the risk that the person on the other side of your trade, your counterparty,
Uh-huh.
can't fulfill their obligations.
Right.
So let's say you agree to buy an asset at a certain price,
Okay.
and that price goes up before the trade settles.
Okay.
If your counterparty can't deliver, you miss out on potential profits.
Right.
That's substitution risk.
So it's essentially the risk that someone might back out of a deal
Yeah, pretty much.
when it no longer benefits them.
Yes.
Okay.
And the longer it takes to settle a trade,
Right.
the greater the opportunity for prices to change.
Okay.
And the higher the potential cost if your counterparty defaults.
So time really is money in this case.
Absolutely.
Yeah. Right.
That's why risk mitigation is so critical in post-trade.
Okay.
One of the primary tools used to manage this risk is a margin call.
Margin calls. Yeah.
Yes.
Those always seem kind of,
Yeah.
I don't know, mysterious.
Yeah.
What are they exactly?
There are essentially like an insurance deposit. Okay.
That you put down to protect yourself in case the other party can't follow through.
Gotcha.
There are two main types,
Okay.
variation margin and initial margin.
Okay.
Variation margin covers those day-to-day price fluctuations.
So if the price of the asset moves against you, you might have to pay your counterparty to cover that potential loss.
Exactly.
I
And
don't-
then you have initial margin.
And what about initial margin?
Initial margin is a bit more complex.
Okay.
It's designed to cover potential losses over a longer period.
Okay.
And interestingly, European regulations actually set minimum standards for the parameters used in those models.
So there are actual regulations governing how they're calculated.
That's right.
Okay.
And it highlights how seriously regulators take the potential risks involved in post-trade.
Right.
And it's important because these margin calculations can actually impact market stability.
Now that you mention it, our sources mentioned something about margin calls becoming pro-cyclical.
Yeah.
What does that even mean?
So procyclical essentially means Huh. That margin calls can actually exacerbate market volatility in certain situations.
Okay.
So imagine the market experiences a sudden downturn like we saw in March 2020.
Right.
Prices drop,
Yeah.
leading to a surge in margin calls
Right.
as counterparties try to cover potential losses.
Okay.
This sudden demand for cash can force traders to sell assets,
Gotcha.
pushing prices down further and triggering even more margin calls.
So it creates a domino effect.
Yes,
Okay.
where risk mitigation measures end up amplifying the very volatility they were designed to protect against.
Right. That makes
It's
sense.
a delicate balancing act.
Before we move on to those CCPs,
Okay.
I'm curious about other tools used to manage risk in post-trade.
Sure.
Our sources mention netting and trade compression.
Right. So
Can you
netting,
explain how those work?
netting is all about offsetting gains and losses
Okay.
across multiple trades with the same counterparty.
Okay.
So let's say we have multiple open trades.
Okay.
We don't need to settle each trade individually.
We can just net out the overall position,
Yeah.
settling just the difference.
So if I owe you $100 on one trade
Right.
and you owe me $80 on another,
Exact.
we just settle the $20 difference.
Yeah. Okay.
There's another type of netting
Okay.
called closeout netting.
Okay.
This comes into play if a counterparty defaults.
So instead of chasing individual trades,
Right.
you're dealing with one consolidated amount.
Exactly.
Okay.
And then you've got trade compression.
And trade compression.
Trade compression is like spring cleaning for your trading portfolio.
So if two parties have multiple offsetting trades,
Right.
they can basically cancel them out,
Yeah, pretty much.
simplifying their exposure and freeing up resources.
Exactly.
Okay.
So all of these tools kind of work together to create a more robust
Okay.
and resilient post-trade environment.
But even with all these safeguards,
Yeah,
things can still go wrong.
absolutely.
What happens when a counterparty defaults? That's where these central counterparties, or CCPs, come in.
Okay, so CCPs.
CCPs,
Okay.
they act as this central hub for managing risk.
Okay.
They step in between the buyer and seller in every trade,
Okay.
becoming the buyer to every seller and the seller to every buyer.
So instead of worrying about the creditworthiness of each individual counterparty,
Yes,
everyone just deals with the CCP.
exactly.
That sounds like a huge responsibility.
It is.
How do they actually mitigate all that risk?
They have a whole toolkit at their disposal.
Okay.
We've already talked about netting, trade compression.
Right.
They also require their members to post margin,
Okay.
both variation and initial,
Okay.
to cover potential losses.
And they have that default fund.
They have a default fund, which acts as a last resort
Right.
in case a member defaults.
Right.
And their margin isn't enough to cover the loss.
So it's like a layered defense system,
Exactly.
starting with margin and ending with the default fund as the final backstop. That's a good way to put it.
And to further mitigate risk, CCPs have strict membership requirements.
Right. So not every market participant
Okay.
has direct access to a CCP.
Okay.
Some operate as clients of participating members,
Okay.
while others are even further removed
Okay.
as indirect clients.
So it's a tiered structure with the CCP at the top,
Yes.
then members, clients, and indirect clients.
That's right.
But that means that while the CCP manages risk for its direct members,
Yeah,
there's still counterparty risk outside that central hub, right?
that's true.
So it's not a perfect system,
The system is perfect.
but it seems like a significant step towards making the market safer and more stable.
Absolutely.
Now, we've covered a lot of ground already,
Oh, yeah.
from substitution risk to the role of CCPs. But our exploration doesn't stop there.
Oh, good.
In the next part of our deep dive, we'll look at how CCPs manage defaults.
Okay.
We'll delve into the intricacies of security settlement.
Yeah. And we'll unpack the crucial role of central securities depositories.
Sounds good.
We'll be back after a short break.
Great.